I don't care how good you are in anything, you don't have discipline, you ain't nobody.
Right.
You're nothing without discipline. Because you give up on the slightest struggle without discipline. Discipline is doing what you hate to do, but do it like you love it.
Hey everybody, we're here with Michele Schneider, Mish. I absolutely adore Mish. She's one of my favorite traders, one of my favorite people. Absolutely love talking to her about the markets. She has helped me so many times with understanding the markets. After years of trading, early in trading, whatever it is, Mish has the answers. Mish also runs MarketGauge. You can catch her on Fox, you can catch her on just about everything. You're on CMC Markets now too. That's what you just said. Yeah, so she's on CMC Markets constantly. How are you doing today, Mish?
I'm doing great, and thanks, Jason. I mean, we have history, right? We met. You became a subscriber when I was running a trading service, and so I feel so proud of everything that you've accomplished. I mean, what's better than that? In putting yourself in a role as teacher, having a student that then excels and goes off on their own and doing so great. So kudos to you, and thank you for having me again.
Oh, of course. You were our first interview actually years ago. So it's
Virgin, virgin
yes.
interview.
And now all these years later, you're still coming on, and not to mention it's like it's always timely to have you on. It's funny because I never think like, oh, I need to have Mish on because of commodities or something. I'm just like, I want to have Mish on, but it's always timely. Every single interview we have is always right on, spot on, something happening that you always have a good idea about. So what are we seeing right now in the commodity space? Last year, we'll start there because last year, commodity space was pretty dead. There was some major moves. Sugar, major move. You called that one. Cocoa was also a major move, which is one of my trades. And then we had what else moved? Orange juice. Orange juice was insane. So there was some major moves there. And not to mention, Bitcoin also continued to move. Now, a lot of people don't think of that as a commodity, but it is labeled in the commodity space. So what are you seeing? What were you seeing last year? Why do you think there wasn't much participation widely in the commodity complex?
Well, there's a few reasons. One is that people got very excited about the fact that the Fed had done their job in terms of really breaking the back of inflation. And in certain areas, they certainly have done their job. If you look at just the numbers that came out today being the 11th of January, you could see that there are areas that have fallen tremendously. And the question is, why have they fallen tremendously? Some of it is just the natural attrition of things that were really crazy post-COVID. And some of it is because of the higher interest rates. When you look at things like used cars, for example, yeah, of course. But does that, when you start talking about why, possible credit event, and you start talking about the fact that there are higher delinquencies going on in certain areas, you say, could that be recessionary? But could that also be inflationary because it puts the Fed in a situation where they've been aggressive, but now can they continue to be aggressive? I mean, in the debate of recession versus are we in a period of growth, soft landing, no landing, hard landing, it's really, really easy to get stuck in that conversation and then try to find evidence for whatever camp you're in. But the point is that when you look at the commodities prices, CPI bottomed in June. And that's if you even believe in CPI prices. We went recently on a trip, and we were in Honduras for a few days, and we met a guy in a candle bath shop. And it turns out that he lived in New York and he worked for a major banking firm as their economist solely to come up with CPI numbers. He would be a fun guy to interview, actually. He was very forthcoming. I guess he feels protected down there. But he basically told me his job was to cook those numbers. And if they didn't like the numbers, they would say, go back and fix it. And so it makes you wonder about CPI as the big judge. And maybe the Federal Reserve knows that, maybe they don't. But getting back to commodities, if the CPI technically, cooked or uncooked, bottomed in June, and we still have some real inherent problems, And the Fed, possibly to avoid any recession, which could be coming based on the inverted yield curve and all the other things, the collapse of the money supply, and they lower the rates from here, it's just possible, and that's what we're watching for with a couple of other issues that we will discuss in a moment, but it's just possible that we go back to the 70s, which is exactly what happened in the 70s, is the Fed misstepped on monetary policy after the recession from 75 to 77. We saw the CPI have a trough in 77 and of course started going wild. The dollar actually started to fail, and even though the dollar has bounced a little bit today, it still looks vulnerable overall. And we have a global situation, which is far different than what we had then. And we have 2 wars, possibly 3. I don't think that China-Taiwan will come out too much, but still a threat. We have weather. And I know that's a hot topic. You and I talked about this. You know, weather. When I talk about weather, I'm not talking climate change. That's irrelevant to me. Politics are irrelevant to me. What is relevant is that just looking at this country, let alone globally, as we were talking about with Brazil, we had 6 tornadoes in the South yesterday. We have a freeze that's going down into Texas. We have snow in the Southwest, unusual. And then we have sort of drought conditions in the northern part of the country, sort of the central mid part of the country. So, you know, this is the kind of thing that's happening. Finland had a 40 below Celsius temperature reading this week. If you put these all together, the potential for a real spike in commodities is still there. And until I see that change, I'm going to stick with that narrative.
No, I completely agree. And, you know, it's interesting to look at just the COT data. You know, if we look at the COT data, and the reason why I look at it and why I think it's important is because that's what the producers are actually seeing. You know, what are they seeing and what are they doing? People talk, you know, they come on TV and they tell you what they're doing, but what are they really doing? What are they really buying? And they're buying the crap out of commodities right now across the board. There's not many that I could look at, that even ones in uptrends, things that with even live cattle, it did come back a bit. The live cattle also is another one that you're looking at and going, oh man, there's a lot of commercial buying. Lean hogs, there's a lot of commercial buying. Everything across the board. Soybean meal, tons of commercial buying. And it's just across the board. So it's like, what are they seeing? And I think it's the same thing that you're seeing, is that we're kind of in this zone at the moment where it's, hey, commodities are not at a crazy price. They might be cheap to a producer, especially. And they also see that the upside is the pain trade, really. You know, most people aren't going to expect a major rally in commodities. And also, just as I know you've talked about before, and I completely agree, the Fed gets behind the curve a lot. You know, I could see it being very similar, like you're saying, to the 70s, where it's, hey, everything's fine. We won I mean, they're pounding their chest now. They're 2%. Did you see that one? They just came out with, I think it was Bostic. He said 2% inflation. We're almost there. We're going to be there soon or something. And it's like, come on, man. And it's like, and I know that they always get behind the curve. It's the same way when you and I were first talking about the inflation thesis, and you were really, really getting into it. And everything was there finally. You know, you had rates at 0, you had unlimited quantitative easing, you had every single ingredient to finally have that trade take off. And inflation did take off. It starts to take off, and they said inflation is transitory. I could see now the same scenario, but in the opposite way, where we won the war, inflation's fine. And next pop that really happens in inflation, they'll probably say it's transitory, it's going to go away soon. And then we just take off. And it already looks like we have all the fuel. Like, I'm literally sitting here just with my charts up, looking at them and just seeing all these inflationary assets moving up. It's natural gas, gasoline, heating oil, crude, all up top, coffee behind it, Brent's, orange juice, sugar. It's wild. We have all the fuel in the world right now for that trade.
Well, yeah, a couple of things to add to that is, one is, I think there's a real misconception about what a super cycle means, because people heard super cycle and they thought, oh, okay, well, that's over. But a super cycle, if you think about it, I mean, the best comparison really would be like going to an amusement park. You know, when you get on a roller coaster, That's what a super cycle looks like. So you have these incredible rallies up, and then you have these big drops, and you catch your breath for a minute, but you get ready for the next ascent and then the next drop. So kind of that's what a super cycle is. And when you have, let's just take sugar, for example, it went still from 6 cents in 2020 to 28 cents here in not here, but in 2023. And now it dropped all the way back down to 20. That's a huge drop. When you get that type of volatility, that is inherent to a super cycle. Volatility and commodities should not go hand in hand. If you really want to say inflation's over, you're going to see the prices stabilize like they had for so many years. That's number one. Number two, in terms of your comment on producers, let's not forget what the commodities market was developed for, going back to corn futures, which is for them to hedge in the market. So if producers are buying commodities, even here, certain ones are obviously much more elevated than they were a couple of years ago, while others aren't, that tells you that they are hedging to be caught potentially with short supply. And finally, I mean, I think it's also really important to remember that as far as the commodities go, somebody asked me a question on Real Vision. I did Real Vision last week. Well, what commodities moved in the 70s and what didn't? And I thought that was such a great question.
That is a great question.
Yeah, the third fallacy right there, which is if it's inflation, every commodity should move. And that's just not the case. If you go back to 1979, I mean, I was on the floor, so I kind of had somewhat of a myopic view, and I could see sugar was going nuts and gold and silver were going nuts. Oil didn't really start to go nuts right away. It kind of got dragged up. But not, I mean, I was also there with cotton and orange juice and copper, and those things didn't necessarily go nuts. I'd have to go back still and research what happened in the CBOE, but I don't think the grains were necessarily going nuts. It was not necessarily every commodity. So you have to get out of your head that we cannot be in any kind of a super cycle with a trajectory up in commodities, and that means all commodities, like we saw after COVID. Because after COVID was, obviously an anomaly, a historical event that we hopefully will never see again in our lifetime.
No, I love that because it's so important to understand that not everything's going to move at the same time, but a lot of them will move, like it's the thing, like we're looking at last year. And even though everybody's going, oh my God, the commodity trade was over, it's the end of it. It's like some of our best trades were in the commodities market still. And then now we're getting into this year, and it's like if there's any, and what you're seeing is probably the same thing I'm seeing, is if there is any fuel added to the fire of commodities, it will rage to the upside, very quickly. There is nothing that I could look at that would tell me that commodities might go lower. Nothing tells me that. So right now we're kind of in the early innings again. I think we'll get into the Fed kind of being just a little bit too passive on it, and then we'll end up where we end up, but once again, it's risk management, all that stuff's important. However, there's a lot of fuel to the commodities trade right now, and everything looks pretty good.
Yeah, so let's put some numbers on it, because obviously we're traders, right? So as far as one of the things that I'm watching very carefully is the silver versus the gold. And I know I've talked about this in the past. When silver starts to outperform gold, that is usually a inflationary scenario. And it hasn't at this point. If you look at the charts right now, right here, silver is trading really around $22 an ounce, where gold is, obviously at 2030. So, you can see the difference there. And so one of the things I'm really watching for, and I think people could watch for, is what happens with silver. I mean, gold has not moved. It's not taken out the highs like everybody anticipated, but it's only 11 days into the year. So have some patience, but watch that silver. If silver starts to take out, even today, I'm looking at it, if it starts to get up over $22.40 an ounce, you have a nice risk to all these recent lows that we've seen. That also could mean that if it starts to accelerate and gold goes up in tandem, but not nearly as much as what silver can do playing catch up, that could be a sign. The other sign I'm looking at for is with sugar, going back to my little favorite commodity here, because it got down to 20, but it's trading at 21.80 as we speak right now. And there are some moving averages, and also just in terms of chart patterns and bottoming formation, that would look like it clears if it can get back over 22 to 22.20. As far as the cash market in sugar, I think that could also be an early sign that the bottom is in. And, you know, I've been watching, what's interesting is I've been watching some of the industrial metals as well. Aluminum, I don't know why all of a sudden caught my eye. I haven't really paid much of attention to aluminum for years and years and years, but I saw Alcoa, it looked like it was trying to break out, but it turns out, you know, that Alcoa is almost like a miner, right? They take the hard aluminum and they produce it, and they're making some major cutbacks and stuff. But nonetheless, if you look at the price of aluminum right here, and I'm just going to pull up that chart real quick for myself so I can speak with some authority. Let's go to my metals here. Metals, aluminum. Okay, so if we look at the January contract of aluminum, what I'm seeing right now is that it broke down, and it broke down hard, but now we're really into some mid-December after a big gap up that it had in December. We're right into that support level. And if it just moves up, say, again, let's put some numbers on it, over 22.20, which is interesting. I said 22.20 in sugar. This is 2,220 in aluminum. Then I think that what that tells you is that we're seeing a bottom there. And then you have to think, well, what does that infer? Industrial metals are needed for so many things.
Yes.
And so I'm looking at that even more, let's say, than the gold miners, which, you know, is probably the most frustrating trade on the board right now. And then let's look at oil, right? So oil, I came into this year predicting that would be range bound, maybe between 65 and 85. But what I decided to do this week was, in the discretionary part of our RIA, which is what I trade, was to buy a half a position here, pretty much around here, at around 72.50 a barrel. It's now trading back over 73. If it gets over, and I do it through USO because we have people who don't trade futures, but I would look at the futures. If the futures get over 74, that shows a really nice big double bottom that we've seen over December and now into January in oil. And then the last thing so that gives you some hard numbers to look at.
Yes.
The last thing I'm going to say is that in next week, there's the whole thing about the January effect, which in an election year is even more important, right? And so we got to remember, election year, certain things are going to be manipulated, like that never happens. And it's going to be try to be manipulated to make things look good. Which, you know, whenever you kind of force, I think of it like pickup sticks. You know, you pick up a stick and nothing collapses, and then finally something collapses, you know, a rising debt, yada, 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 low money supply, like I said, Fed not really sure what to do. But in an election year and in January, you get a very important reset, the 6-month calendar range, January calendar range. And actually, Jeff Bish and I are going to be doing a video for stock charts, which will be available to everybody on the calendar range, which should be out over the weekend. Once you have that range set in January, it's very compelling to buy it once it takes out that range, maybe to realize that you could get chopped up. There could be a reversal where it takes out the range and then breaks down below it, a little bit choppy, to sell it if it breaks down below the range, or to avoid things that are chopped, but really find the things that either break out smoothly or break down smoothly. And I think that applies for commodities, everything. So that's kind of, I'm sort of waiting for that, because I think that would be a really good guide for what to do this year in terms of those ranges every year, but this year more so than ever because of the election year.
No, I completely agree. You know, it's one thing that's awesome, and I always love having you on because of the trading aspect of it. So we all make calls, right? But really the trading aspect of it, putting numbers on it, where's the breakout, what should we be looking for, and so on. That's real trading, and that's the thing I always love about Mish. Mish is like the most genuine, authentic person out there when it comes to this stuff. And I try to be as genuine and authentic as I can be as well. But Mish is just always on point with that stuff. And this is all things everybody can look for, coming up into the future. So you're trading, you're not just thinking about, hey, you're talking about commodities going up. You're also seeing that, hey, this is our plan. This is our game plans. This is what we're doing. Because we are traders, we're not on here just talking about things. We are actual traders. There are people who come on and just talk about things. You want to follow the people who are actually trading.
Yeah, I mean, and it's sort of like, considering I started as a trader on the commodities exchange floor, even though we're decades later and I'm much older, I really haven't changed. I mean, I still, and on the floor, there was a couple of things that were so interesting. And I know we did a segment, I think a couple of years ago, where lessons learned on the floor. Well, one of the biggest things, and especially with all the contention that we see constantly, is I never knew who anybody voted for. And I'm like, shoulder to shoulder with these guys. I go home with a hair full of their spit by the end of the day. It's intimate when you think about it.
Yeah.
Yet, I never could tell you who voted for who believed in what. We were there to make money. And sometimes in the cafeteria, there'd be sidebar conversations about things, but in the pit, it was money, 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 money. And what we've learned, and we can move over to Bitcoin and equities from this conversation. But what I learned is obviously, you hear it all the time, price matters, but it really does matter. And, as we've started this year with this big rally all of a sudden that we saw in December, even though we had the first week of January come off a little bit, but then the rally that we saw in the Dow, or the rally that we've seen, well, at least maybe it looks like it's subsided somewhat today, but not very much in the growth stocks. Everybody's thinking value. The lack of the rally we've seen in the small cap stocks. This is really how I frame my economic picture, not from listening to some economist who's getting paid to say certain things by whoever is paying him or her. Or they, to be politically correct, but really by what the whole market is telling me, and particularly my economic modern family.
No, and it's true, and that's how I do what I do as well. I obviously learned a lot from Mish over the years, and for me, when I'm seeing relative strength flowing into areas, I will then create my outlook based on that. I don't just create it based on what I'm just looking at, reading the news. Everybody knows what's in the news. Everybody sees the headlines. What's not being said? Well, relative strength, positioning, what the actual price is doing, because price, no matter how you look at it, price affects the fundamentals, because if the price is going up in oil, it's going to also affect the CPI. It's going to affect everything else. So you have to pay attention to price above everything else always.
Yes, because Jason, sorry to interrupt you, but CPI and so many of the numbers are lagging indicators.
Yep.
As a trader, looking for leading indicators. And that's the big difference for people to really get in their head, is don't trade off of something's lagging. Try to find the things that are leading, which is why I've given you these price parameters, because to me, those are leading indicators.
Yes. So looking at oil, the one thing I would love to talk to you about more is one thing. So I put out a report just the other day, and I made this very gaudy chart, which has 1,000. It doesn't have a bunch of indicators, but it just has a bunch of war happened here, this happened here. Looking at today, and seeing the environment that we are in, there's a lot of people who would go out on a limb and say, hey, we're in World War III already. I don't know. I'm not trying to claim any of that. What I am saying is that we are in a global strife at the moment. There's a lot of things going on.
And even Ecuador has joined the party in terms of revolting.
Yes. So there's a lot of things going on, a lot of things affecting shipping, a lot of things affecting the world, especially oil. We're back, the Middle East is another hotbed. It's been a hotbed for many, many years.
Oh yeah, Libya is also now starting to act up a little bit again.
Yes.
Protests there. threatening the oil supply. So go on, I'm sorry.
Yeah, no problem. Please add in.
Well, I have to because I won't remember after you finish.
I'm the same way. But so talking to you, my thought was looking at basically 99, and you're a person perfect to talk to about this. 99 to 2003 looked very similar to 2020 to now. Granted, there's not the same exact catalyst, of course, but 99, you have oil going down to $10 a barrel. You have 2020, you have oil going negative in the front month, $20 cash. Yeah, and that was wild. And so you kind of look at 9/11 per se, and you also look at Russia invading Ukraine and all of these things, and now we're in Israel, Hamas, and this whole situation. And kind of like my thought of looking at it, you could add in and tell me what you think about this, is that we're in a very similar time frame. It looks like oil is kind of set up to move. We have this geopolitical event. We have the possibility of the Fed. We have, all of these things kind of correlating very similar to that time frame. So I guess to ask you, what were you seeing in that 99 period? I know we've talked a little bit about this off mic before, but I don't know, what were you seeing? What are you seeing today? Are you seeing any of these same correlations like I am?
Well, probably the most glaring correlation is what happened in the dot-com bubble, and obviously the high valuations that we're seeing in the growth stocks now. And if you look at charts on that, and actually I have a couple of really good ones, not like right here at my disposal, but you can easily find them. You can see that the valuations now and what we saw in the dot-com bubble before the bubble are pretty much the same. Mm-hmm. So that's something to take home with you, because it would be one thing if those valuations were high and the rest of the market was also high. You can say, well, there's just so much liquidity, doesn't matter, we're going to avert some kind of potential bubble. But the other really interesting thing is, I love to call it, the crocodile jaws, so you have growth and you have small caps. You have NASDAQ and your small caps. And they were starting to narrow a little bit at the end of 2023, but now they're widening out again. And you know that at some point, like a rubber band, these things snap. Mm-hmm. So those to me are probably the two biggest analogies to what happened at the end of right, really before the millennial, right? And so you had that big whole Y2K scare that didn't turn out to be anything, and then you had 9/11, and and so it's you can obviously remove what the headlines were and insert new headlines. But besides what I just mentioned in terms of the NASDAQ and the overvaluations and how it looks so much like the bubble that we had, essentially in terms of the geopolitical situation, when 9/11 happened, that was terrorist on our soil. We haven't had since. In terms of the question about World War III, I'm probably not necessarily worried about that, because I think the U.S. military, we're badass. Let's face it. I don't think anybody really wants to screw with us to that point of starting a World War III. However, that's because we're thinking guns and ammo and bombs. I think the World War III has started a little bit here through BRICS, even though BRICS has been 10 years of a conversation. The more we separate ourselves from Russia and China and the Middle East, the more incentivized they could be to join together to try to break the back of the dollar. If you want to really hurt the U.S., you don't lob a nuclear warhead at us. Yeah, that would hurt, but we're just going to blow you up completely after that. You go for our infrastructure, cyber attacks. I don't like to talk about it, but that's certainly a possibility, as we know. Or you go for our financial system and you break us one way or another. And the easiest way would be through the oil market, priced in something other than petrodollars. And BRICS, which people think is a big joke, because I can understand the US is just doing so much better than everybody else, but that doesn't mean it necessarily stays that way. So that's kind of what you have to keep in the back of your mind. We still go back to our point, but though before, Jason, is that watch the price here. But yeah, you got to say, if we're going to do some kind of an analogy to what happened in 9/11 to what happens now, it may not be flying a plane through the World Trade Center. It might be something much more insidious in essence. And that's not to have any lack of sensitivity to what happened. We worked in the World Trade Center. We lost a lot of friends that day. This is more to be practical minded about what could happen now.
No, I love that. And it's all it's eerie, and like you said, the BRICS nations are kind of interesting, and it could be, you know, World War III could be fought without, like you said, it might not be guns and bombs, and this time it might be completely cyber. You know, you never know exactly the way that all could go, but looking at all of it and seeing how it's just fascinating to kind of see the correlations from 99 to 2020, and kind of where we're at today. I really like the idea of just kind of watching the price at this point, being open to that we are in kind of a situation very similar, and seeing where we end up from there. That could be kind of the way to handle this, if anything else. You know, number one, you always have to risk manage. I think oil gives you a great exit point at this point to just be out of the trade. The risk to reward looks great. I know you like to probe trades like that. Like I thought about that the other day. I'm like, that's a Mish setup, because it's a probe trade that's just perfectly set up for very low risk, high reward. So right now it's going to be very interesting as I'm sitting here watching natural gas just skyrocket all day long. It's up 6% now. You know,
yeah, and that's another. You know, we talked about this, over $3. Natural gas looked like a buy. It spiked up to 340. It came back down yesterday, actually, and tested like 295, and now, of course, it's back up again. And 315 was sort of my pivotal number in my CMC day trading mindset. But nonetheless, it stopped at the 200, and so now we have to watch that 340 level. We take out that 340. I mean, we'll look at 4 next. I mean, obviously, there could be resistance along the way. It is natural gas. But yeah, that's definitely, now it could be seasonal, but it certainly also could be something worse. So yeah, that's the whole energy space. I mean, well, look at Buffett. I mean, my God, he just keeps buying more. His 34% of his holdings, I just read today, are in Occidental.
Yes.
I mean, yeah, that's pretty extraordinary. Now, you know, people can say, speaking of oil and dinosaurs, that he's a bit of a dinosaur too, but you know, it does definitely makes you wonder. I much rather listen to what he has to say than some of the other big fund managers. So yeah, let's talk about Bitcoin for a second, and also getting back to probing, because I think so when Coinbase was down at around 70, 75, 80, I probed that a couple of times. I bought it over 80, and I got I think I got stopped out once. Then I bought it again, and this time I said I'm not getting out unless it seriously breaks 70, and that's a big risk, $10. But that's because I knew the potential. I mean, and that's the reason why I probe. I never care about losing controlled money on a probe. Now, if I probe 3 times and it doesn't work out, okay, I'll walk away from the trade. But in this case, I probed once. Second time I got rewarded. I want you to know we took off our last bit of that Coinbase trade at 160. That's 100% return. This is why I'm mentioning this is not like, oh, yay, me, but more like, you know, for people who are interested, listen, people who want to trade momentum, that's a very serious way to make money. You know, Isaac Newton, you know, the law of physics, which is things in motion stay in motion. And certainly with commodities, when that happens, we've seen it. And that's great. I'm not the best momentum trader. I wish I were better, because I had some unbelievable calls in momentum, like AbbVie Pharmaceuticals, which basically just rallied $10 from the start of the year because it was on the highs. I told people to buy it. We bought a little bit, but we didn't really get into a full position. I'm a prober. That's my personality. You got to find your own personality.
Yes.
But it's been extremely successful. But that doesn't mean that I just bottom picked for the heck of it. Right? I had a feeling that Coinbase was going to rally ahead of the spot ETF in Bitcoin. We were long Bitcoin. We got out of a good profit target today, but I figured if it would go from 46 to 47, maybe you would test 50. But now it's going to be like, okay, everyone's going to pile in. but then it's going to come back off. I'm not going to buy it here just on the basis of a dip. I want to wait. And it's the same thing with oil. I bought it today because I have, or not today, but a couple of days ago, because I have a real floor. And now I have, you know what? It hasn't exactly been hit hard enough. And I could see the momentum was turning to more bullish divergence. I have a good risk. I lose money. I lose money. I bought a half a position. I'll add to it if I'm right. And so it's everything I do like that, but that doesn't mean I'm always right. But I try to find good reasons for it. And then, of course, good old technical analysis, however it is you like to use it, really helps, in terms of the probing. You got to have, like, if we have a tradable low, which could look like a reversal pattern, a V bottom, or however you want to look at it. In the case of natural gas, it was a long period of consolidation that broke out of that consolidation and a major trend line. It's probing with a purpose.
Yes. No, I love that, because it's important to understand everybody's different. I'm wired. I'm a very good momentum trader. Pullbacks and probing isn't how it worked for me nearly as well. So it's just however it fits for you. Everybody's different. And what you said, I also want to get into a little bit more. You try something 3 times, sometimes it doesn't work, sometimes it works the 4th time. I think that's an incredibly powerful statement that a lot of people don't get. Paul Tudor Jones talked about it, in Market Wizards. It was Paul Tudor Jones. I read on the headlines, Paul Tudor Jones calls the top. And then really he said, yeah, really it's Paul Tudor. Doesn't sound as cool to say Paul Tudor Jones calls the top on his 5th attempt, exactly. Because that's the
Paul
truth.
Tudor Jones, if I may date myself a little bit, and I were on the floor together at the same time.
Nice.
So I used to bump into him in the pits a lot. He liked to trade oil. He liked to trade, believe it or not, cotton or orange juice a lot. He and I are cut from the same mold. I mean, the fact that he went on to be a billionaire, good for him. But he stuck to one thing. I mean, my biggest thing, and I know you can relate, is that I like to be kind of spread out.
Yeah.
And also because I'm a teacher, so I like to teach. But Paul Tudor Jones, of course, he's going to probe. That's what he does. Mark Fisher, same thing. Another guy who I still have indentations of his elbows in my shoulders because he would stand behind me in crude oil. But he was a great prober and didn't care. You lose money, you lose money, you lose money, you lose money. If you look at, you could trade 10 times, and if you bet, just to make it simple, I shouldn't say bet, but if you risk $1 each time and you lose 6 times, you lose $6, right? But if the next 4 times you make $2 or more, you're ahead of the game.
Yep.
Yeah, it's not a matter of, and that's a basic principle that goes from the marble game, which goes back to Van Tharp, who talked a lot about position sizing and probing and all that other stuff. That's basic trading. Behooves anybody who really wants to be in this game to learn it. It's not that complicated to learn. And you can do it by just trading one thing, maybe a couple of things. That's the other thing. People think they have to trade like 50 million things. In commodities, we didn't do that. If something was hot, we stuck with that.
Yes, because you have to go where the liquidity and the momentum is. You really do, especially as a floor trader. And I also see that a lot. People will watch me, for example, and they'll see that I trade so many different futures markets. And really, that took a long time. I couldn't do that when my account started. That's impossible. My account was nothing when it started. So years and years later, and like I also run funds for other people. I manage money. I'm a portfolio manager. So yes, now I have the money to trade all these different markets. But like back in the day, even buying something like a palladium contract, that was just out of, it was impossible. So it took years to grow from, and I remember the first futures account I made, I had 10 tickers that I would watch. That's it. Just 10. There was soybean minis that were small enough. There was, I think orange juice was small enough at the time, and a couple other minis and micros. That was it. Just to start. So, you don't have to start with 50, 60 products. You don't have to start with the whole stock market. Just pick a couple things, a couple ETFs, and just learn like that. And, I brought that up about the probing because I see that with energy a lot. A lot of the people who traded energy from, what was it, 2015 to now, they
Mhm.
got hurt so badly in 2015 to 2020 that by the time they got to the point where you were like, hey, there's beautiful trades here, there's beautiful trends, it's set up perfectly, nobody wanted to do that. They would literally, I remember like going to a conference with a bunch of traders and having a conversation, and me, I'm kind of a caveman trader, you know, like it's making a new high, it's giving me a signal, it's, you know, it's, and I'm like, great, I'm gonna buy it. And I try to keep that mindset, so I'd rather take a small loss than miss something. And I've learned to do that over time. And I've
Yeah,
seen
it bothers me much more when I miss something than when I lose money, because
exactly.
and that's when I get really angry at myself.
Hmm.
You know, what are you afraid of? This is part of it. You cannot
Yes.
be a professional lifelong trader if you're worried about losing money, because they
Mhm.
constantly miss opportunities and they
Yes.
get reckless.
Yes. And I want to get into more, you know, how do you keep that mindset, you know, where you're, because mental health is obviously extremely important as a trader. It is the most important thing. I tell people this all the time. If my mental health isn't okay, like even though like I know for a fact that running systems, because primarily most of what I do is systematic, that if I stop trading, I will lose a lot more money, but I still take breaks. And the reason is that I still think my mental health is much more important. I still have to hit the trigger. I still have to put up the buy stops. I still have to run the systems. I still have to do all of those things. And I probably will start missing it if my mental health is off. So how do you keep your mental health on point all these years, you know, as a trader?
Wow, what a great question. Well, since I'm always incredibly honest, some
Mhm.
might say to a fault, that's just the way I roll, because my job at this point now is not just to keep my mental health sane for me, but also I feel a responsibility, since I'm trading other people's money like you. And by the way, I want
Mhm.
to talk to you about your portfolio management when we're done with this.
Mhm.
But so here's what I do is, first of all, this is hardcore, and I've discovered recently a big hotbed of a topic. But I've been vegan for 40 years now. I'm
Mhm.
vegan because I was born not being able to digest anything dairy, and then eventually meat, and I got sick as a teenager. But what
Mhm.
it's done for me at this point is that it's definitely, for me, I'm not saying anybody else needs to do that, but this part of my thing is, even if you're not going to be any kind of hardcore vegan, and believe me, that is a tough life choice. Um, Eating right is a huge part of it. I mean, if you throw a lot of junk into your food, into your diet, that's going to come back and hurt you. And with that, also, I have to maintain a certain level of exercise. I need to keep
Mhm.
my body strong and fit. When I start to feel like it's winter, and I have the gym today, but I skipped the gym earlier in the week because of the weather, I start to feel it. Um,
Mhm.
and it's certainly no weather for going out for hiking or walking. I do a lot of that. In terms of my mental health, I really believe in the power of, however you want to do it, whether it's prayer or what have you, some level of a
Mhm.
meditation.
Mhm.
And in the program, as they have you focus on God, whatever God means for you.
Mhm.
And this is not to say whether there is a God, isn't a God, or who cares. The point is that whatever that is that gives you that sense of being able to surrender your mind to a higher power,
Yes.
be able to talk to it, and realize that the thing you need more than anything is to understand that obstacles come in your way, to try to meditate on removing the obstacles so that you can get to where you're going, whatever that is. And that if obstacles appear, they're there for a reason, and consider that feedback.
Mhm.
And that's probably, of all the things I just said, the hardest to maintain, because we tend to get into victim mode.
Mhm.
Why is this happening to me? Why am I losing money? Why? I suck.
Yeah.
That, and believe me, I've been there many times.
Mhm.
But I recognize it. I'm old now, so I recognize it almost immediately, and I step back and I go, no, it's time to, have some quiet meditation, understand what's going on, why the obstacles were there. I put them there. Maybe sometimes it's just shit happens kind of puts them there. And that's really, I think, what most traders have to do. When I worked on the floor, I would leave the floor. First thing I would do is put my feet up for about 30 minutes just to kind of get the blood going from one way to the other way. And then I'd go for a run. And that run became essential. I don't run anymore. So like I said, it's really whatever you can do to clear your mind, whatever it is. I mean, some people just like to go crazy, put on headsets and blast out to heavy metal. Fine. If it clears your mind, go for it. And you've got to find a way to do that. People overthink. They overthink and they drive themselves insane.
Yes. No, that's a great way of saying that, because I think it's incredible. And it's not a straight road, you know, like there's days where I get stuck and months where I get stuck and things like that. And that's where I'll take a break from trading, you know, but I think, like you said, like my thing is I go ride my bike or I play basketball. Like I do this 7 days a week, you know, which is a little bit possibly too much, but I know that I have trouble. I have trouble quieting my mind. I always have. And my whole life, it's just, that's the thing that I've never been able to do very well. But when I am doing something active, my mind is quiet. And I can finally think after that and think what I'm doing wrong and start to meditate and reflect on it. You know, the thing like in the program, it's all about character defects and trying to figure out, you know, what I'm doing. And that's what I try to do as a trader, is like, what's my tendencies? Like something that's really important that people don't talk about enough is like, what's your tendency as you started to trade? What was your biggest problem? You know, mine was oversizing, mine was bad risk management, and you can fall back into those things pretty easily. The thing that I notice now, just like you said, is I can recognize it now. That's the only difference. It's not that I don't, those thoughts still come to my head. I'm making a good trade. Hey, natural gas is going really well, Jason. You bought it. Maybe you should just triple the position, you know, like you got plenty of margin, you know, like something stupid comes in your head. The only difference now is that
not stupid if you have a plan.
Yeah. Well,
I mean, you know,
there is no plan. If there is no plan, it's stupid.
We humans are programmed to fail. This is something I've talked about through the years. I mean, just our DNA, going back to caveman, you mentioned that you trade like a caveman. Well, if we think about caveman times, you know, it was fight or flight, right? And so we kind of were our history as human beings were always to expect some level of failure and to survive through the possibility of failure. And we've taken that, many people take that into their trading. So when they're making money, they get out way too soon because they almost can't believe it that they're making money. They don't deserve it or whatever it is. Or, you know, wow, this is crazy that I'm making money. I better get out now. And many people sit way too long with losses because they, you know, okay, I can take the pain. I can take, you know what, I'm used to pain. I'm a human being. I know what pain feels like. I'm going to have pain, and I'm just going to hope that things turn around. So, you know, it's good to understand those areas. And the other thing is, I mean, really for me, the best thing to do is when I put on a position, I really, really think if the stop is arbitrary, I won't. I mean, again, I make this mistake occasionally, and then I get pissed off at myself when I do. But when I nail it, and I bought something because there's a historical low to trade against, if I'm that kind of a trader, or if you're a momentum trader, if it breaks back down into the resistance it just cleared, you have a stop that really makes sense and it's not some arbitrary stop. Then I can go away. I don't even have to watch the market. And that's how I clear my head. I may set a couple alerts on my phone because I have my platform on my phone. So it let me know if something is breaking down or getting to a profit target. But you really have to learn how to control the impulses by understanding that your strategy that you just put on, it wasn't wary-nary. It was actually well thought out, very logical, at an incredible point of risk. And it's worthwhile doing. And here's a great example. I'm watching DBA today. DBA, you know, had this huge drop because I think it went ex-dividend or something. I don't know, something. I forget what the reason was. So it literally went from 22 down to like 2090 overnight. It was spectacular. And I got caught up in that. So I lost some money. Okay, fine. That was completely out of my control. That happens. And I haven't traded it since. But now I'm watching it. but I will not trade it unless I am 100% sure that the bottom that was in, A, confirms it's sitting right over the 10-day moving average today after making sort of a V bottom, and B, I know that I can take that low, it's a good low, put a stop under that low, position size so that it, if it happens, big deal, it's like my probe, and that's it. I won't look at DVA again. I mean, I watch the markets every day, but you know what I'm saying. I won't look at it and second guess myself.
Yes, and I do the same thing where I don't watch my once the trade is on, I have my stop. Usually I use trailing stops, and that's it. I don't look at it anymore until I get the exit signal. If I get an exit signal, I'm out, or if the stop hits, I'm out. That's about it, and that helps me to not just sit there and watch every tick because I'll drive myself crazy. By caveman, I kind of mean is just like you said, we all overthink, and so what I do is go, okay, all my work that I've done over time, all my back testing, my risk management, getting ready for the year, my whatever models I'm using, if I have the right signals, I take my own thoughts out of it. Last year is a great example. The NASDAQ. When the NASDAQ gave me a buy signal, this was in, I want to say, maybe at end of January, beginning of January, somewhere in January. I literally looked at my system and I said, the NASDAQ, no fucking way. I was like, no, because it's literally like the market looked terrible. Everything looked bad. It was just starting to pick up. And at that point, every single signal was nearly a false signal for a while. And so I just looked at it and meant, man, I really don't want to buy the NASDAQ. But I just shut my brain off and just hit the button. And once again, it was a really great trade. They had two really great trades in the NASDAQ and the swing futures portfolio, and then one really great trade in the long-term portfolio, and called it a day. If I would have overthought that, thought about what I believed the market was going to do, at least tech-wise, I would have never had that trade. So I think it's important to be able to shut down. And like you said, I've seen this more than anything in trading, just like you said, which is phenomenal that you said that, which is people buy something, it goes up a little bit and they go, take the money and run, and really it's like sometimes you never know, like when something's going to be the big winner. If you're trading like I trade, for example, and this isn't how everybody trades, but how I trade, most of my money is going to be made in only a few things. So if I'm sitting there missing out on, let's say natural gas continues to run another 100%, and let's say I just sold it today because I'm up a lot, I'd miss out on a great trade. Same with, any of the trades that I'm putting on. Like I have to really be willing to let that upside happen. And that's an important part of trading.
Well, yeah, and this probably should be the last thing we talk about because I don't want to overstay my welcome, and we've given a lot of information here, but because of everything we just talked about, Keith, my husband, and Jeff, our partner, and James Kimball, and a couple of other people too, but those mainly have created these quant models over the years. And the quant models were designed more in line with the way you like to trade, which is on momentum, trend, strength indicators in a ranking system. And so we started out with one model, which was our NASDAQ All-Stars, and it did unbelievably well because of the big move in NASDAQ a few years ago. And since then, we've created about 10 to 12 different models, including a fixed income product because of obviously the nature of the interest rates. And so the reason why I'm mentioning this is because it was designed to do exactly what we're just talking about, which is to take mathematical formulas and put them to work with risk parameters and profit targets so that it becomes so automatic so you can take your own ego and brain out of the equation, because as we know, your mind is not always your friend. But that's also evolved because now we're at a point where we realize, one model does well in certain scenarios, another model may not do as well. Because of that scenario, market conditions change a lot. So now what we're doing is we're doing a blend so that we're offering people an ability to buy a blend based on their risk appetite, whether it's conservative, moderate, or aggressive. And that really smooths out the returns. And so we've kind of evolved. This discretionary trading that you are talking about,
Mm,
I'm still doing because people want that and it's fun and I'm good at it. But
yes, you are.
really the future, especially with the AI component right now, which we're putting that flame of AI under all this, because we just are working with this guy who is, my God, just such a genius when it comes to this stuff. That really, I believe, could be the future. And even if you don't want to buy into a blend with smooth returns, et cetera, the idea is that you evolve where you can even mimic that in your own discretionary trading, where you have a couple of asset classes. So if one goes up and the other doesn't, your returns may not be spectacular if you catch one move in one thing, but it'll keep you as a lifetime trader because you will have good returns solidly and never have a year that wipes you out.
Yes, and that's incredibly important. So that's awesome, Mish. Thank you so much for coming on here. I think we really nailed a lot of hot topics. I think people will really enjoy this one. And as always, I had a lot of fun chatting with you.
Thank you, Jason. Me too. And the one, I mean, we didn't mention anything about equities, but like I said, keep an eye on that January calendar range reset. Check out the video that Jeff and I are going to do, because we're doing it from an instructional standpoint. And that will really help guide you on whether or not we've seen the top in January in these indices, or you know, whether we're going to get through that top at some point and then continue the rally, or we're just going to chop for a while. I'm agnostic. That's what I keep saying about the indices right now.
Yes, and make sure to follow Mish on Twitter, follow MarketGauge. She has all types of information, just like this and tons more, much deeper, all types of macro models, the economic modern family, and so on. So make sure to follow Mish, and we'll talk to you all soon.
Thank you so much, Jason.